Good morning, and we'll dive straight into reactions for the Australian dollar through the last 48 hours. We've seen a steep downward correction and year-to-date lows touched yesterday at 76.87. The rot really started on Friday evening as an uptick in the US dollar driven by stronger macroeconomic indicators led by consumer sentiment and industrial production drove the world's base currency higher into the close, and that coupled with risk-off appetite and an uptick in US Treasury yields forced the Australian dollar down from 78 cents to 77.15 on Friday. Those losses continued through trade on yesterday as that risk appetite failed to return into the new week, and we're now looking and testing lows at possibly 76.90 moving forward as we look to the week ahead. With little data on our own docket, we do look to the RBA minutes today, but expect very little action from that in terms of its impact on the longer term outlook, as we expect the RBA to maintain the recent rhetoric that it's delivered. Our focus instead looks to the Federal Reserve and the FOMC meeting on Wednesday, where they are expected to in fact raise interest rates and put US interest rates ahead of our own for the first time in a long time, since the GFC in fact, and that in turn gives the US dollar yield advantage to the world's base currency and puts further pressure on our own unit. Interestingly, as a side note as well, we saw the Great British Pound surge overnight as EU negotiators were able to draft an interim deal that we expect to be signed off and lead into a 21-month transition plan. That upside advantage for the pound comes as the risk of a cliff would drop for the pound on the back of an unfavourable exit strategy is removed, and we now look to see what that deal entails and how issues over Irish border disputes in that financial sector are resolved. For more commentary, don't hesitate in contacting our dealing teams.